Hi everybody, Jeff Yastine here. Welcome back to another edition of Wealth Press TV. As always, make sure to like and subscribe to us, follow us on social media. So my guest this week is Josh Martinez of Traders Agency. Josh, welcome back to Wealth Press TV.
Hey Jeff, appreciate you having me back and excited to be here.
Josh, I think the last time you and I talked here was a couple of weeks after the election. So it was mid to late November. And you were watching very carefully this 30-day window after the election and where the markets finished at the end of that 30-day window, because you had a certain number that you were looking for that your analysis had shown. If it finished at or above that number, you would tend to be bullish for the coming year, and if it finished below it, you would be more likely to be bearish and go short in your futures contracts for the coming year. So where are we on all that?
Absolutely. So we were looking at the NASDAQ 100, the S&P 500, and the E-mini Russell 2000. But I monitor the futures side, and we were looking at the monthly time frames to see if they can close above resistance. And great news is all three closed above resistance. And I know that one of the things we talked about last time was the betting on the Fed continuing to print money and to provide another stimulus, which can also drive the market up. And it seems like we were somewhat spot on that.
Josh, just to get some clarity here, I mean, on the one hand, you're saying that the markets look good based on your analysis, but you're also saying be careful.
Yeah, so there's a couple of things. A correction or a retracement is a very real thing. And at the end of the day, right now, in my humble opinion, there are zero or very minimum financial consequences for Americans right now. And what I mean by that is, if you think about it, you can't pay your bills, no problem. Can't get kicked out of your house, right? Your business goes under, no problem. Government will send you a check. You can't pay your payroll, no problem. Government will send you money for a payroll stimulus, right? So what's happening here is a really weird scenario where, yes, there are businesses going under, but if they apply for financial aid, they're getting the aid. If you can't pay your bills, you're getting a forbearance, which means you're not getting kicked out of your home. And so the question is, are those things going to continue? And if the answer is yes, then what happens? The Fed continuously prints money. If they continuously print money, it devalues the U.S. dollar. A devalued U.S. dollar causes higher inflation. Higher inflation means you have less buying power, so things become more expensive. An example of that is you have $100 in your bank account right now, and that $100 can go buy you 100 pencils. But next year, that $100 can only buy you 95 pencils. So what happened? Pencils became more expensive, but you still have the $100. So if that continues, then realistically, my assessment is everything's going to continue to go up because natural inflation, things become more expensive. But, however, if forbearance ends, landlords are able to remove tenants who are not paying, banks are able to foreclose on homes, then what's going to happen? In theory, you're going to have a flood of inventory inside of the housing market. You're going to have displacement of people and families, and more inventory, in theory, could cause supply to go up. So therefore, demand goes down, and if demand goes down so much in the housing market, builders, people who build the actual homes, they're not really going to be incentivized or really anxious to build new neighborhoods, and that's going to cause, that's going to cause a lack of jobs. Because think about it. Look at all the companies that are involved in building a new home in a neighborhood. Someone has to buy the land. Someone has to clear the land. The company has to lay down the foundation, the roads, the utilities. Companies for concrete, companies for windows and doors and toilets and roofs. And if the housing market dips because forbearance ends and there's a huge supply and builders stop, we could go into another bearish dip bigger than what people are anticipating. So the way that I heard another person really explain it very well, and I wish I knew the person's name off the top of my head, but I would just say an unknown quote. Earthquake, tsunami. And what I mean by that is, so we had this earthquake in the middle of the ocean, and the people on land, they felt the earthquake. And what's happening is the ocean is pulling the water out, but the earthquake appears to be over. He's like, this is kind of weird. The ocean, the water's pulling back, kind of weird, but the tsunami hasn't hit yet, and so we haven't really felt the after effect. And what I mean by that is the coronavirus, in theory, that's the tsunami, and it shut down the whole world. And the water's been pulling back, but we haven't felt the full force of the consequence yet because there's been these bailouts taking place from all around the world and the Fed taking place. And what I mean by that is if that ends, in theory, the tsunami is going to come. Businesses are going to hurt even more. People are going to hurt even more than what they are. So there's a really fine balance. And so what it all means is this, in my humble opinion, is markets are high. Essentially, as long as the Fed keeps doing what they're doing, as long as the Fed keeps bailing everybody out, printing money, inflation is going to go up. In theory, the market's going to continue to go up. But the moment that ends, everyone's going to need to be, intentional about not putting all the money on the table right now, because everyone knows what goes up has to come down. And the question is, everyone's kind of looking, where's the catalyst that's going to bring the market down? No one really knows at the end of the day. But the assumption and the theory is going to come from the housing market or the retail side, because there's such a huge domino effect in that industry. When new homes stop being built, jobs are heavily affected. And so that's kind of, so if I were to talk about this, I would say, hey, enjoy the ride, play the buy zone, sell zone game. As long as we're in the buy zone, keep making the money in the way up. But the moment we get in the sell zone, be quick to take the chips off the table.
Josh, I'm wondering, are there specific numbers, specific price targets that you're looking for with the major indexes? Again, talking about the futures market here, before you would expect to see some sort of change in trend.
Yeah, let's go through them. So we'll start with the NASDAQ 100. It's a very popular future symbol. It's just been cranking. The ETF will be QQQ, monitors the technology side. But essentially, we're in the buy zone on the monthly time frame. As long as the NASDAQ 100 on the future side stays above 10,927, then we're in the buy zone. And in theory, I'm anticipating that NASDAQ to continue to rally towards 16,000, which is a monstrous push, because if you think about it, we're talking about another 25% increase, but that's what is going to be called for if it continues, if we maintain the buy zone. Now, we take a look at the E-mini Russell, the S&P 500, another very popular one. This one broke into the buy zone already. As long as it stays above 3,600 on the S&P 500 E-mini future side, I'm going to expect a continuation of the bullish movement. Now, what's weird about this one is I usually utilize Fibonacci's on the technical side to help me find the projected areas, but your Fibonacci extension has already been hit on the monthly time frame and has already been hit on the daily time frame, but we're still going up. So right now, it's just a pure buy zone, sell zone game. As long as it stays in the buy zone, momentum's still up. So we're just looking for the scalps on the way up the smaller time frame. And then you have your E-mini Russell 2000. That thing's above $2,000 mark on the index of the future, and that one's heavily in the buy zone, almost a parabolic move. It's just going straight up the last 3 months. And realistically, that one, we're anticipating a retracement. But if I had to give a number now, this one's tougher. As long as it stays above 1,800, then we're going to anticipate the continuation of the bullish movement. Everything else will be just viewed as a retracement. Nobody knows with 100% certainty. There's no guarantees on anything. If there was, I would raise $100 billion and go for a 2% move and then be done for the rest of my life and generations to come. Okay, so let's just be clear of that. But the way that I view the market is I try my very best to view it as simple as possible. What I mean by that is there's only two choices, up and down, buy or sell. So if you were to close your eyes, put a blindfold on and flip a coin and guess the direction, we got a 50% chance of being right and a 50% chance of being wrong by just guessing. Now, there's what's called probability. And probability just means that you can find patterns in the market which tend to repeat themselves over and over and over again. And ideally, we use patterns that work more than 50% of the time. Because at the end of the day, this is about making money over time. So if we go to place 10 trades and we win 6 of those trades and lose 4 of those trades with good risk management, we're still making money over time. And that's the way this works. Now, there's areas in the market that I'm a big believer, after 10 years of doing this, that the market tends to U-turn at, on, and or around the same price points. And you see these in channels, where you have a bottom of the channel and a top of the channel. And oftentimes, individuals will begin to buy the market at the bottom of the channel, and then they will say, I'm holding my buy trade until the top of the channel. Whenever the market's at the top of the channel, it's very natural for people wanting to sell because it's visually friendly. Now, sometimes it breaks above the channel, but most people do take profit at the top of the channel. Now, you can get in advanced techniques and utilize Fibonacci sequences. Now, I love the Fibonacci sequence. And so when someone gives a specific price point and says, this is where I believe the market's going, usually there's a Fibonacci sequence behind it. And that sequence or that price point becomes very accurate.
Josh, I just have to stop you there for a second. You mentioned Fibonacci numbers or Fibonacci's. So talk a little bit about that. I know what it is. I use it in my own trading, and I love putting it up on charts. It helps me to see things that are not very clear otherwise. So explain about Fibonacci numbers, because it's actually a mathematical progression that we find quite often in nature, correct?
Fibonacci's was discovered by a gentleman named, I believe it was Leonardo da Fibonacci da Pisa during the Roman era. And he didn't create it, he discovered it. And it's known as a natural governing law of nature. And it's a sequence. That's a mathematical sequence. So it's like 1 + 1 is 2, 1 + 2 is 3, 2 + 3 is 5, and so on and so forth. Then there's square roots, and then there's divisions involved, and so on and so forth. Basically, this sequence is utilized in all aspects of the world. Architectural design utilizes Fibonacci's. Painters use Fibonacci's. Plastic surgeons use Fibonacci's. Your belly button is traditionally the 0.618 of the width of your body. We also utilize Fibonacci's inside of the investments market: stocks, options, futures, cryptos, forex, you name it, precious metals. We can utilize it. And what they do is they find hidden levels of U-turn. And what I mean by that is there are price points in the market that you just can't see with your naked eye because they're hidden. They're mathematical equations where people or robots or indicators will naturally buy or sell positions which cause the markets to U-turn. They form lows and they form highs. And so we utilize a sequence to help us identify hidden levels of U-turns where people naturally buy, people naturally sell. It's the craziest thing in the world. I know it. And when you hear it, you're like, this is just phony baloney. And the only thing to say is you got to see it, because once you see it, I've seen thousands of examples, and every time I see it happen, and it literally calls it to the exact price point, the penny, hits it, and U-turns, I'm blown away every single time, because it's just one of those unbelievable aspects that, in my opinion, every trader should know. It's very interesting, too, because you can do the math with a calculator. And if this was like 30, 40 years ago, that's what you would have to do. But now, because it's 2021, you have the Fibonacci sequence, is known as the retracement tool, on many of the indicators. But the default settings of the retracement tool, what I found on platforms, is the equation is often broken or backwards. And so I usually find myself having to update the equation on the settings to get to accurately project the way it needs to project for the approach that I take.
Josh, you mentioned that you try to keep things simple. You look for patterns. I'm wondering if you are also including visual chart patterns like double bottoms or double tops, those sorts of deals.
Oh, really great question. So I'm a technical trader through and through, and I'm a very basic type of trader. I don't really like fancy, complicated, difficult systems at all. I like the things that are easy. So what I mean by that is I'll use just basic trend lines, and the trend line to find U-turns that will divide the market in the buy zone, sell zone. If we're above my trend line, I'm going to look to buy. If we're below the trend line, I'm going to look to sell. Now, I just follow 4 rules, and these 4 rules, because my brain says, look, I can only buy and I can only sell. The market can only go up and it can only go down. So if I have a 50% chance of being right or wrong, if I just guess, how can I ensure or do what I need to do to win more than half my trades all the time. And it's not perfect by all means, but there's 4 rules I like to follow. Number 1, buy low in the buy zone. Number 2, sell high in the sell zone. Number 3, do not buy high prices. Number 4, do not sell low prices. And they are so simple that I get made fun of all the time online when I bring them up, because it's like, oh, buy low, duh. But at the end of the day, I explain it in a way to where it's like opening up your refrigerator and then you're trying to find the ketchup and you're looking in the back of the fridge, but the ketchup's right there in your face. It's just so obvious we overlook it. And at the end of the day, if we just buy low in the buy zone, which requires just a simple uptrend, in my humble opinion, you can dramatically increase your winning percent. Now, I also utilize, other techniques such as, head and shoulders. I'll use channels, and then I'll use trend lines. Nothing fancy. I don't use anything crazy. Usually, the first thing you're going to learn at trading, that's what I use. Right. So if the price is already high, don't buy, because money's made by buying low and selling high. Don't sell low prices. You want to buy low prices and you want to sell high prices. Now, I'll just say this. I've trained thousands upon thousands of people, and if you view my social media outreaches, I've had millions upon millions of views. And one of the things which I have learned over the years is the people who do not make it in this business of trading are those who risk too much in a single trade, because it doesn't matter how good you are. In my opinion, most people, once every 2 years, they're going to lose 10 to 15 trades in a row. It doesn't matter what it is. It just happens. Now, the question is, do you have staying power so that you can go through 10 trades, 15 trades of losing, and then have a set of rules, like what you just stated, a strategy or a formula of success that can make all their money back plus profit. But it's one of those things where it's like, you pray for rain, but you got to deal with the mud, and the losing trades that's the mud. And are you going to be able to deal with that as time goes by? And that's what's really important about having a set of rules, is to get you through that mud and muck, but also having good risk management so you can make the money over time.
Control, because that's something I know for me that it took me a while to figure out, because my instincts and my trading systems were correct, but I would make money and then I would lose it back, and then I'd be back in negative territory. I'd trade my way out of that again and then slide back into having a loss in my portfolio. And the thing that helped me was to realize that when you lose 10% of your overall portfolio's value, it takes 12% in gains to get back to where you were before. If you lose 20%, it takes 25% in gains to get back to break even. So obviously you lose 30 and 40%, the numbers make it almost impossible to sort of climb out of the basement. And a lot of folks, give up at that point. So it really is very, very important, as you said, to make note of how much you are betting on any one particular trade, because if you have 10 bad trades in a row, and it can happen, especially in markets that are fast moving, or you're bearish and the market's bullish, that sort of thing. 10 bad trades in a row, for a lot of folks, you bet too much, it's game over.
No, it's a really great point. And at the end of the day, in my humble opinion, it just comes down to what is that formula for the person who's watching this, right? If I was talking to someone directly, I would just say, look, for every 10 trades you place, how many are you going to win? How many are you going to lose? Okay. And if you place 20 trades, how many are you going to win? How many are you going to lose? Place 30 trades, how many are you going to win? How many are you going to lose? And then if you look at 30 trades, let's say you go, well, I'm going to lose 12 out of these 30 trades. Great. Can you lose those 12 in a row? And if the answer is no, then you over risk. There's really 2 types of people that I've realized in trading. There's the person who really knows what they're doing. They're educated, but they're so smart that they believe in their trades. They risk too much money. And that's the person who always says, oh, I'm losing, but I'm always right. I can predict the market, but I'm always losing money. And then there's the person who's also educated, right? These are 2 educated people who trade with good risk management, They make money. Their biggest complaint is, I just want to make more. But the key is, person number two is, if they just stick with it and they compound over time, they'll make more money than they could ever dream of, because they have a formula of success that's allowing their accounts to grow. Or person number one, they know what they're doing, but they're always losing money because they're boom and bust. They lose 2 or 3 trades, but they're risking 10, 20% per trade, and they can never get ahead. It's like you said, you lose 10%, you got to make 12 just to get back to break even. It's like, but sometimes what I've seen is, it's not until a person just gets tired of losing, they go, enough's enough, I'm just so sick of this. They either A, they have good risk management and they make all their money back, or B, they just quit because they're like, I don't want to do this anymore. But at the end of the day, what we as educators, what we want everyone to do is trade with good risk management. We want everyone to have a good formula. We want everyone to have a good strategy, and we want them making money over time, because that's where the real fun happens. So one of the things that we suggest to our students is 25 trades. And what I mean by that is, I met a gentleman at a conference, and he was an educator, but he also was part of a band. And I asked him, we were talking, I go, when do you and your band feel comfortable enough to write a new song and then play that new song in front of a paying audience? Like, how do you know when you're ready? And he said something that kind of was impressive. He said, well, we practiced 25 times, and if we could do 25 times without making a mistake, then we'll go sell tickets and we'll go play the song on stage. And I thought, well, that's really interesting, because if you correlate that to trading, once you learn a new strategy, a person should really open up a demo account, practice account, place their strategy 25 times in a row following the rules. And if they can follow all the rules without breaking the rules 25 times in a row, then they're going to get a strong understanding of the win-loss ratio, the drawdown, their stops, their limits, etc. They make their silly mistakes, and then they're ready for live money. But most brokers, they allow you to audit your track record. So, like, for example, Ninja Trader does a complete statistic breakdown where you can see every entry, every exit, every drawdown, every win-loss ratio, and it gives you a summary. And so we're a big believer of place those 25 demo trades, right? If you can't make fake money with fake money, how are you supposed to make real money with real money, right? Place those 25 trades, monitor the trades, experience the drawdown, experience the profit opportunity, and then then from there make the decision on your risk management. But I'm a big, big believer in somebody monitoring their trades and their performance along the way. Absolutely.
Josh, you and I have been talking here about the stock market and the futures indexes as it relates to the stock market. I'm wondering if there's anything else within the futures markets that you would be watching here in the coming year.
A opportunity which I think would be a really smart opportunity would be gold. I think gold is going to be the one to watch this year, 2021. And the reason why I believe that is because usually during uncertainty and high inflation periods, like right now everyone's printing money, high inflation periods, people turn to the gold standard. Gold on a technical level does show about a 5,000 to 6,000 tick increase on the future side. It's about a 35% increase on gold itself, physical gold. If I give you the specifically speaking, I am anticipating over the next year to year and a half gold to go to 2,486, and that's going to be about 5,000 ticks away. In the futures market, you can trade an E-mini for about a $2,000 investment, and every tick is worth about $10. And so a 5,000 tick is equivalent to 50,000 US dollars. So we believe gold would be gold futures would be a nice one to monitor to intraday trade, to be able to make 400 to 500 ticks, which is like an extra $4,000 to $5,000 a month over month. You can also trade a micro, which is a $200 investment. Every tick's worth $1. That's between $400 and $500 a month, which is nice. But you can also trade the ETF on gold as well. And so there's, anyways, I think that's the one to monitor this year.
Josh, one final question here. For a lot of folks, whether we're talking about futures trading that you do or stock market stuff, there's a intuitive understanding about buying breakouts, or especially for the futures markets where it's easier to go short. you would sell a breakdown. But the thing that frustrates a lot of folks is when a favorite stock, or in your case, the futures index, goes into a trading range where it will trade up to a resistance level and fall back to some support point. And it just keeps going like that. And people wind up losing money because they keep expecting a breakout or a breakdown and it doesn't happen. So I'm wondering if you have some solutions to that.
There are techniques for an individual to do shorter term swing trading, not active trading as in buying and selling, 1 hour to the next hour, but, buying on a Monday, closing out by a Friday, buying on a Monday, and then closing out within a 2-week range. So we utilize a technique called money magnets. And money magnets, what it does is it monitors, it's a week by week scenario, but it's one of the neatest things. It monitors the previous week's low price and high price. And what it does is it runs an equation of the previous low and the previous high, and it'll give us a price point. And that specific price point is given on the following Monday. Somewhere on this page, I think it's down below, there's going to be a link. And if somebody wants to click on that link, they can learn more about the technique itself and how it works. But it's really impressive. We've been utilizing it for quite a while now.
Josh, I'm so glad we're able to bring you back on the program, so thank you.
Absolutely. It's an honor to be here, and it's always a pleasure.
My guest, Josh Martinez of Traders Agency. And for all of you, remember to like and subscribe to us, follow us on social media. I'm Jeff Yastine. We'll talk to you again next week.